Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hey, this is Brent with Black and White Market Minute for another week. Got Aaron, Sam, and for some reason we keep inviting Henry back, but we're here, so I'll let Aaron get us started over here.
You have no idea how much we had to practice that intro with Brent. So if you see him, really congratulate him. He did a good job. Back to the market. This has been, actually not a lot has happened this year. Our ups and downs are about the same. It feels a lot worse than it's been, but this week has been rough. I mean, we've had a lot of selling. And we're going to get into that, and we're going to talk about some ways around it. But first, let's jump right into the very exciting part of the fixed income. And tell us where we're at on interest rates and all of that.
Well, and when you're talking about selling, usually people are buying something. And what are they going to be buying, Brent?
All right, yeah, we can jump on the rates. So as far as looking at the treasuries, 2 to 10, the curve's normal. If we just really all we're doing is kind of looking at the same things this week, the real short-term treasuries or CDs sitting around 4.1, 4.3%. So again, if you're not getting that, that's what you should be getting. If you want us to do some, get that in and get that to work for you, let us know. But like I say, not much change.
It's been pretty crazy. I remember even earlier this week, as get up early and watch a financial show in the mornings while I'm getting ready for work, and short-term interest rates jumped below, or I guess fell below 4%. So, it's not just the stock market that's being volatile. It is all financial instruments. And really, y'all have heard me say this before, but the fixed income, the interest rates, all that, that's really the smart guys in the industry, other than Brent. But that's where the smart money really is. And if they really can't tell what's going on in the market, there's a lot of uncertainty. And, at the end of the day, when we're looking at super short treasuries, we should be looking at a zero real return, which basically means we're not getting any benefit after inflation is accounted for. So, I mean, it may sound small, but jumping from 3.9.5 to 4.1 in a week time frame, that is a 1 month treasury, that's a lot of uncertainty. And it does trickle through to the 2 year, the 3 year, the 5 year, the 10 year. And, it's kind of hard to wrap your head around it right now. But what came out today? Today's not a fun day in the market. But I know we got some inflation readings. And really, was there any surprise?
Yeah, this morning around 8:30 Eastern time, the PCE data for the month of February came out. Just going off the top of the head here, I know month over month we came in as expected at a positive 0.3% month over month jump. And then I believe the core PCE data also came in a little hotter than expected. So I didn't see how just that little hotter than expected print came in that would really spark the sell-off today. We are recording Friday, the 28th of March here. The market is down pretty big today, but I'm not sure.
What is PCE again? Personal consumption? Just a plain old everyday inflation reading, and really no changes. Maybe the market was expecting things to be getting better, and that's why the sell-off is. But man, if you're living on this planet, I don't think there's been any change in what we're paying for food, what we're paying for housing, filling our vehicles with fuel. Inflation isn't coming down. Regardless of what these prints are saying, we all feel what's really going on. So, today's numbers were no different. Didn't change anything. So it's kind of surprising how much the market is moving on this.
Well, and eggs have definitely come down, but eggs have been the political talking point. So kind of one thing to keep an eye on is if you see something about a headline, you go and you watch those politicians really use their leverage to make those headlines look better for themselves and for the campaign prospects for the midterms and the upcoming elections. So you may say, yeah, these inflation numbers feel better, but you're probably looking at egg prices or whatever headline item they're talking about being so expensive, or on the other side, Trump's come in and prices of eggs have dropped through the floor relative to what they were a year ago. And so you see a lot of headlines about that, but it's all just messaging. It's all just kind of coming from one side of the aisle or the other, trying to highlight what they're doing, but they're definitely not going to be building headlines about the things that are not going well.
Right. And I think that's so funny you just bring up eggs. There's big fear with the bird flu. So it was government mandated that almost our entire chicken population was put down. I mean, we lost the majority of our chickens in this country. So, of course, there's not enough egg layers out there. So that should have all gone through the roof. And, yeah, chickens replace themselves pretty quickly, but it's not overnight. We should take, it's going to take a year before things get better, maybe even 18 months on that time frame. But it's funny if any kind of politician goes out and tries to use that for or against, somebody else, because all of this stuff works together, and it paints a big picture. And, anybody that tries to point at one specific thing and say that's the problem or this is the fix, they're campaigning or they're selling something. It's funny. But, overall, this week has been pretty weak for the overall market. It hasn't really been devastating. I mean, today's really not fun. This was a big day down. I think the NASDAQ's close to 3% down. But, at the end of the day, we were overpriced. We were sitting at about the 99th percentile of valuation. We're hoping it comes down. And, for those people that are invested in more than the Mag 7, you're happy. You're actually feeling good because your companies aren't going down near as much. They don't have enough of that froth to sell off. And there's still fantastic companies out there doing what they're supposed to. I was just reading an earnings report, and guess what? Just as many companies are outperforming on the revenue side. Just as many companies are outperforming on the earnings side. The earning surprises to the upside are relatively the same. So, if you can separate out the stock market versus the companies that are inside the stock market, those companies are doing okay. And they're doing just as good as they were quarters ago, when the market absolutely loved it. And, the market is nothing but a group of people trying to decide whether they want to buy or sell a security. And, when you're in a market, it doesn't matter if we're buying stocks, bonds, eggs, Ziploc bags. It doesn't matter. There's a group of people that are either going to push price up or push price down.
Supply and demand.
Yeah, and that's why it's so important to have some kind of conviction in what you're buying. Because right now, we keep talking about this. This is a fantastic time to be buying. And if you've set yourself up for success where, you have some money on the sidelines or you have access to capital where you can take advantage of this.
Feels good to put it to work.
It feels good to put it to work. And that's really what we're doing right now. So not quite through. We're getting awfully close. So any amount of weakness, we are celebrating, to tell you the truth, that this is good stuff.
Well, and whenever you see market volatility increase, you said if you're not in those Mag 7, you feel a big relief. You feel good about what's going on because you're outperforming some of those indexes most likely. And so the other thing that tends to do well when volatility spikes is hedge funds. If you're able to get access to those different asset classes that operate differently or behave differently than your main equities and your main bonds, or fixed income, then you're probably getting maybe a leg up on, more retail type investors who don't have access to those things.
That's a great point. I mean, just looking at the market, everybody knows stocks and bonds, Amazon, Apple's, all of that. But there's about 25 times, not 25%, 25 times the number of private companies out there. There's a lot of different ways to invest that does not include the everyday stock market and bond market. And like Sam said, if you want to take advantage of volatility, let's invest in things that do well when volatility pops. And hedge funds is a great example. You know, those things should be really boring and nothing you really want to brag about until things go bad. And when I say bad, I'm just talking about things get more rocky. We get more volatility. And a lot of hedge funds invest in that. You know, they are looking for volatility to rise up from one asset class or one security to the next, and they really, really do well during those times. But there's other asset classes or other private asset classes out there that can help us take advantage of different times in the economy. And really, if you're looking out there and you're missing out on 25 times the amount of investment opportunities, you need to find a better way. So, Henry, you were showing me stuff just on private companies, how many they were, and it's amazing about how many more. You know, how big is that asset class?
Just looking over, this is across the entire world, like as Aaron said, the 25 times more private companies in the world compared to public companies. Yeah, it's true. A lot of opportunity out there. The market size, the public market cap of public companies is sitting at a little under 88 trillion. That's worldwide, and then you look over into the private market value at 11 trillion. So definitely a lot more growth in the private sector.
Yeah. You know, right off the bat, when we're saying private companies, there's tons of private companies out there that you have no idea. You know, we're not talking tiny little companies. Let's just say Kennedy Financial, or, you know, these are huge companies. You know, I've had a lot of people call me and say, "Hey, I want to invest in SpaceX." Well, that's not very easy to do because that's a private company. You have to go through a different structure to be able to even have access to that, and that's a private. You'd have to go through private equity, or if they were wanting a loan, you'd have to go through private debt to even get access. You know, some of the other big ones that maybe people have heard about is Betterment. It's an investment platform, kind of like a robo-investor.
Is Grubhub public yet?
Nope. Grubhub is still private. You know, the last time that this market was really heated and really taken off, I think, was in somewhere around 2021. There was a big movement through investments in private companies through SPACs, SPACs. And if you all remember the DJT, or Donald J. Trump, that was a big one. There were some big ones that came out during that time. DraftKings. I'm sure everybody's seen those commercials, especially if you do any kind of online betting.
Or if you even watch ESPN.
Yeah.
Just commercial. Every commercial is sports betting now.
What's the other? There was another space company, Atlantic.
Virgin Galactic.
Yeah, Virgin Galactic. That was another big one. There's tons of companies. And if you think about it, all of them started out private. Uber was a big one not too long ago. Facebook. That's been a huge one that's gone public within the last, 10 years or so.
Yeah, and there's a whole movie about that one going from private to public.
Yes.
That's a great movie.
And you know what? Once a company gets in the public markets, they have a lot more weight on their shoulders. They have to meet with investors. They have to do quarterly conference calls. They have to deal with all the analysts out there. And they have to deal with the SEC, all these new regulations. So a lot of companies don't like to do that. So we're seeing more and more companies hold on to the private side for longer and longer, so they don't have to deal with it. They can worry more about building the size of their company and taking over more market share and do everything a company should be doing rather than making Merrill Lynch happy or
having to publicly disclose everything they do.
Yes, that's exactly right. And you know, we've already touched a little bit on the hedge funds, but you can actually buy the company, and that's through the private equity side. Or, you know, there's a lot of companies out there that don't want to give up ownership of their company. If you're buying their stock or buying ownership, that's exactly what we're doing, buying part of that company. So a lot of companies will say, "Hey, I just want a loan." So they end up going through the private debt side, and that's just basically loaning them money. And banks really aren't set up to do that anymore. They really don't want to loan money to these large companies because it's big chunks, really, really big chunks of capital. And with everything that's happened since 2008, regulations have put a big barrier on them on what they can do and what they can't. So we've had these investment firms step in and say, hey, I'll loan you money. And it's lucrative.
And if you think about it, it's kind of like, say you're the bank, there's this company, this young company, not really that big of a track record to date. Would you, okay, for example, would you, say you're a mortgage lender, would you give someone a mortgage with an 800 credit score or a 350 credit score? Which one would you rather spread the risk around like that? And that's why I think the private equity's taken off, because just lending.
So would you say that the private equity companies are more around the 800 or the 300 mark?
That's really where the expertise of the credit analyst comes in.
Is that the right way to think about it, Brent?
Credit score is a funny thing where if you're thinking of these private companies that are showing success and they have the cash flow, and you would assume with that success they have savvy to have that good what you call credit score. So it's more so the risk of just being new. So what do banks like to look at? They like to look at historical numbers. They don't have the history to back that they're going to continue that performance and growth. Going back to just talking about getting financing from banks, the big joke has always been if you want a loan from a bank, you got to prove why you don't need the loan. So, so I think, like I say, you're absolutely looking at it from a risk standpoint. I mean, the credit score comparison makes sense in a way, but it's really like they're going to have that credit. They're just not going to have that historical financial performance backing to show that they're going to be able to continually perform and, I guess, know what they're doing in simple terms.
Yeah.
Well, and when you say risk, we talk about volatility as a risk metric, but when you're thinking fixed income, define risk, because it's not the same thing as when you buy a company and the price moves. What are you talking about when you say risk? Is it
risk of like company risk?
like default risk?
Yeah, like default risk. So
Okay.
Can they pay it back?
Yeah, so they're going to pay it back. Obviously, when we look at fixed income or anything debt wise, they're the first ones to get paid back, and if you just go all the way to bankruptcy or anything like that. But still, are they going to be able to pay back in bankruptcy? So I mean, there's a lot to it. But like I say, it is less risk, of course, as we know. When you look at fixed income compared to equities, there's always less risk. But I think that's where it kind of gets exciting, talking about private debt, where we can say fixed income is a little bit exciting because it is kind of alternative fixed income source. So I don't know if Sam and Henry agree over there because they talk about how boring fixed income is, but I feel like it's exciting.
No, it is. And, I touched on this earlier. The fixed income guys, that's the brains in the room. If you think about the equity or the stock guys, those are the raw, sell, sell, sell. The fixed income guys, they don't care anything about that. They want to get paid back. They don't want to lose a penny. Sometimes they might lose out on some interest payments, but at the end of the day, they want to be paid back. So even in the private debt world, they're tearing apart that company so much more than an equity guy on just to make sure that that loan that they made to that company is secure. I think there's one company out there that we're dealing with and looking at. Their average loan to value is under 40%, like 38%. So whatever they're loaning, they have 1.5 times backing to make sure they get their money back. If something falters, they have all those assets, over 100% of the assets to pay back that loan. And like Henry said, a lot of these private debt companies, they are perceived to be more risky because they're newer. They're taking a concept and making it work. So it's not like they have 20 years or 30 years of history. So you have to know the management. You have to know their accounting. You have to know how good the board is and every little aspect to it. And just to make sure, that you're loaning money to the right people.
Yeah, like I say, the experience comes from who's supporting the company in the sense of who's running it, who's the management, like you're talking about, is that's where they're looking at the experience. Is like, do they know what they're doing? You know, the companies obviously knew the experience isn't there, the financial history isn't there. They're performing well, but who's behind it?
And a lot of these companies that are loaning in the private markets, they're huge. They're massive, massive companies or massive, massive investment banks. And they wouldn't be here if they weren't able to really understand the credit markets and the companies that they were evaluating. So, you know, at the end of the day, we really have to rely on the expertise of those analysts. But, you know, if they're right and they're doing what they should be, the investor actually gets paid very, very handsomely. What is it? Some of the private debt markets we're seeing, they're getting paid 12 to 14% on the loans they're making to these companies. And you kind of look at it, and it's not that the company needs the money to, you know, stay alive. They're needing this money to grow. You know, they're looking at it as a line of credit, you know, inventory control. What do I need to do to grow? And, you know, if your company's growing at 18, 20%, why not take out a loan for 12 on 40% of your company? You know, you're just leveraging up your growth that much faster. And most of these companies can pay off this debt relatively quickly. And they just stepped up the amount of warehouses they had, factories, whatever it may be. And they were able to do that in 3 to 4 years rather than 20. And they just had to pay a very small piece to get that done.
Well, and going back to that loan to value, as their value, they leverage up, like you said, and as their value grows, their loan to value decreases.
Yeah.
So the faster the company grows, the better
those
secured,
metrics look.
Yeah, the better secured
absolutely.
the company is. Yeah, okay.
So, you know, a lot of these companies that do this, they build a reputation. And they would not be here if they let their investors down or they did something wrong at any time. So they basically bet their entire business and their entire companies every single day that they're doing the right thing. Because at the end of the day, you fail, you're not ever going to raise another penny in any industry or any fund whatsoever again.
And even when you look at loan underwriting, I mean, 38% loan to value is rare. So, I mean, you have, there's a lot of strength there. You got this, and then you got this, you know, good EBITDA. You got this free cash flow. You're checking off a lot of boxes that you would say, per se, the banks are doing when they loan. And like I say, you can kind of almost look at it conservative in nature to a sense, but there's a lot of advantages to it.
Yeah.
In short.
I mean, look at it when you buy your own home. You know, most banks want 20% down.
Yeah.
So they feel secure. I mean, you can get loans with 5% or mortgage loans with 5% or 10% down, but you're going to have to pay another insurance on it to make sure that you pay it. It's going to be a more costly loan. But you look at some of these private debt companies that are doing the right thing and doing it the right way. They're having companies put down 40%. So, I mean, they're doing it right. They really want to be here tomorrow and keep doing the same thing. But, you know, the big thing, boy, we dove off in the woods there. The big thing is we're dealing with companies that not everybody can invest in. You know, you have to have a level of sophistication or a level of assets to even get access to this stuff. And it doesn't act like the stock market, doesn't act like the bond market, not all the time. So it can really, really boost your after-risk returns.
Well, and the hard part, the reason that the hurdles are so high to get into it is because it's really hard to get your money out of it once you're into it, with the exception of following the schedule that the company has outlined. So you look at your account every day, you get your emotions involved in how your accounts are performing. That's not the way that this works.
No.
You lose the password you get your monthly or quarterly updates and revaluations of your investment, of course. Not to mention your tax documents and things like that. But you truly kind of hand the keys to somebody else for a time frame so that they can make sure that, and they're doing it with self-interest. Their incentives are to do the best that they can, which reflects better in your account. So the incentives are aligned. You don't have to worry about your emotions. You know, the market's down over, or the technology index, the NASDAQ is down over 2% today. What is your private equity down? Who knows? It doesn't get revalued. And so going in and logging in and looking at it and feeling that dread of all the red numbers, that goes away.
Removes
with that.
all the emotions.
Yeah.
It's
So
beautiful.
that part of the portfolio is, it's more stable. And I say that, let me take that back. It's not more stable. I would say it prices less frequently.
Less frequently.
Yes. And so it prices differently. So if you look at correlations, and we're going to get into the weeds for a second, but whenever one price goes up, another price going down, that's inversely correlated, or it behaves the opposite of. And so part of portfolio construction is you want something working for you all the time. So when your equities are working, typically your fixed income is not working as well. But whenever your equities fall apart, with the exception of a couple instances, historically, one of them being 2022, your fixed income usually help offset some of that. And then so whenever you start adding these other asset classes, instead of one price working against another price, you have one price working while another price is kind of working, and then something else is not working, but there's always something working in your favor.
Yes.
Smooths out your returns, improves your volatility metrics of your portfolio as a whole.
And returns over the long term. But you know, you're always going to have to give something up to get access to that. And you know, it's the beauty of portfolio construction and the bane of portfolio construction. And you know, even as something as, hey, I invest in gold. Well, even if you invested in gold, you got to store it somewhere. You have to have the guard outside. You have to have the 6 foot of concrete guarding it. You know, and yeah, I'm exaggerating a little bit, but there's extra cost, and that's what you have to pay for to have access to that. And we're used to that. On the private side, you got to give up some liquidity. You have to give it time to work. And I think the easiest way to think about it is, you know, if you did have a mortgage loan, and let's say me and Sam bought that loan, and I said, hey, Sam, I want half my money back right now. Would Sam do that?
I'd be very upset.
He'd have to come up with the capital, or we'd have to ruin the debt to get it out. And he'd have to say, no. You know, this is a 30-year mortgage. You signed up for a 30-year mortgage, so that's what we're waiting for. And I'm not saying private debt, private equity, any of that stuff lasts 30 years, but there is a liquidity cost. But, you know, on the private equity side, you're getting paid for that a lot. I mean, it's going from about 10% in the market versus 15 to 18% in the private markets. On the debt side, you're going from about 5% interest rates to 12 to 14% interest rates. You're getting paid. You're getting paid handsomely. You just need to understand what you're getting your hands on. And, you know, buy it proportionally for what you need. You know, if you have something with liquidity constraints on it, you just want a little bit. You know, I think we try to limit our stuff to about 5% on the illiquid side. Now, not 5% total, but 5% to private equity, 5% to private debt, 5% to hedge funds. You know, and, you know, they all have a different liquidity schedule. We can get access to our assets at different times. But, you know, even if we can stick to that, that's still 85% that you can get your hands on. So make sure what you're buying is proportionate to your life.
And I think anyone would be on board with giving up some liquidity for 12 to 14% return.
Yeah, nothing's wrong with that.
I think it all comes down to your time frame. You know, if you're going to need your money in a few weeks, we're not going to go out and put you in the S&P 500. But if your time frame is, I have these, Jim calls them buckets, I have these assets set here that are going to be earning this risk-free rate, and then I have my equities for the next 2 to 7 years. So what's after the 7-year, 5 to 7 year time frame? Well, if we have that amount of time and we have our plans built correctly, then we can really set something back to start compounding at a different rate and not have to worry about needing access to it.
These are things that you want to benefit for the rest of your life. That's not until December. That's not 2 years from now. This is, hey, I want your life to be better 10 years from now than it is today. And again, that's the beautiful thing about portfolio construction, is having somebody that can put together that beautiful, perfect picture, and it works out in almost every scenario, and it sure works out in the long run.
And I think it all, a lot of what was just discussed ties back to the importance of diversification. Word used a lot in portfolio structuring. So, diversification.
Amen.
That and coming back to life planning, we're a life planning firm. So the advisor builds the plan, and then the asset manager tailors the portfolio to the plan.
Yes.
And so that's the objective, that's the goal. We're trying to do
Yeah,
that.
that's the goal. And unless we're doing something like education planning, where we have a beginning and an end, my son's 10 years old right now, and by the time he turns 18, I want to have college paid for the next 4 years. Most of the planning is for the rest of your life. So if that's your time frame, then you need to be investing that way.
Let's plan for it.
Yeah, let's plan for it. I love it.
All right, Henry's got
One
something
second,
to
we'll
add.
close with this. Would y'all say an example of maybe at the micro mini scale of private equity would be like the show Shark Tank?
Yes.
Yeah,
that's
that
a
would
great
be
example.
Yeah, that's exactly right. The micro scale. And that is an awesome show
Love
to
that show.
look at, just to see CEOs and what it takes to grow from the beginning, and then needing, any company needs capital to grow, and that's what we're doing in the private market, whether it's buying the actual company through the equity or the debt. We're taking those beautiful ideas and pushing them. And it don't matter if it's a $100 million firm or a $100 billion firm. There's opportunities out there.
All right. Thanks, everybody. That's another episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.